Hi, everyone, and thank you for joining us today for the 2020 Building Industry Insights and 2019 Highlights presentation. I'm Gina Carosa, Senior Marketing Specialist at Johns Manville, and I will be your moderator for today's presentation. Today, we will recap 2019 forecast versus market performance and take a detailed look at the trends we can expect to see in 2020. In addition to breaking down industry performance across construction types, our presenters will also discuss the impact contractor confidence is having in the market. Joining me today is David Reeves and Donna Laquidara-Carr from Dodge Data and Analytics, who will do a detailed dive into the industry outlook for 2020 to help you prepare for next year. I'd like to now turn it over to our presenters, Donna and David.
Hello, and thank you guys for joining us today. This is Donna Laquidara-Carr. I'm really happy to share some insights with you. David's going to kick us off, but I just wanted to give you a quick introduction to me before we started fully. And I have worked for Dodge for well over 25 years and have been involved in construction industry analysis. In my full-time function, I do a lot of research on construction trends. We publish them in our Smart Market Report series and in the Commercial Construction Index, which you're going to find out a lot more about in a little bit. But with that, I'll hand it over to David.
Hi, so my name is David Reeves, and I'm a senior economist here at Dodge Data and Analytics. And basically, as a senior economist, I analyze and forecast construction activity in the U.S., where we key off general U.S. macroeconomic trends and regional patterns. Before working at Dodge, I worked for IHS Markit, where I was a senior economist there for their U.S. regional team, where we focused on metro and state knowledge. And here with Dodge, I contribute to the Construction Market Forecasting Service, which provides 5-year projections for 22 U.S. building types. And with that, we are going to begin. So starting out with the general macroeconomic overview, we've all heard the general grumblings and uncertainty that revolve around a slowing global economy as whispers of a potential recession circulate. While the economy is certainly slowing, and we do forecast a GDP deceleration of 2.3% to finish out 2019, with a further deceleration in 2020, we are not calling for a full recession at this time. The fundamentals of the U.S. economy remain solid for the most part, with healthy job growth and consumer spending. Low interest rates continue to encourage borrowing and investment, and a recent 2-year budget deal will encourage that was signed in early August will raise the debt ceiling further. Obvious detractors to this include trade tensions, lack of skilled and available labor, generally a weaker global economy, and uncertainty revolving around the current political atmosphere. Regionally speaking, the West is outperforming the rest of the nation significantly. Looking at that color gradient at the bottom of this map, the lighter colors, be they red or blue, are closer to the average performance by GDP of the nation as a whole. The blue tinted states have a higher GDP than the average state in the U.S., while the red have lower GDP than average. The red doesn't necessarily mean negative, just that it's underperforming compared to the average of the nation. Generally speaking, this makes sense in terms of the U.S. population's current migration patterns, which I'll show you on the next slide. You can note in the upper right that just some of the fastest growing states, which include, Washington, Utah, Idaho, all these states that are in the Sun Belt. Moving specifically to migration patterns, technically the graph is showing you population change, but just adding further color to the previous slide, you can see that the blue tinted items represent where population is increasing faster than the national average, which is 3.4%, while the red tinted states, again, lag behind the national average. Unsurprisingly, the fastest economically growing states are also posting some of the most impressive population growth. The biggest standout where this isn't true would be California. You can see how California is a gray state close to the average rather than exceeding as it did in economic performance. That's mainly because the living situation in real estate is so expensive, it's a significant barrier for new residents who might want to move into the state, but simply can't. Noted in the top right column, you can see that some of the fastest growing metros by population include Dallas and Houston. On this graph, supporting our general theme of an economic slowdown as we leave 2019 and head into 2020, the latest jobs reports from the BLS have been steadily declining over the previous few months, as we can see from the bar chart, While the bar chart is just through the third quarter, October's data did come in a notch lower again at 128,000 jobs added. While November's jobs report did exceed expectations, coming in with a preliminary figure above April's amount of jobs added, don't get too excited about the 1 month, as a large portion of this boost was due to the end of the GM strike, as employment in motor vehicles and parts saw a significant uptick. While the general metrics for the economy remain healthy, with consistent job growth and low unemployment rate, the labor market will continue to tighten as we can see a consistent deceleration of growth moving into 2020. Touching briefly on construction material costs, you can see at the graph where we have the general CPI, which is just your average bundle measuring inflation, and then the PPI of construction materials there. Looking at the graph, we can see there are spikes in 2017 and 2018. In 2017 specifically, lumber tariffs were enacted, and then in the following year, steel and aluminum tariffs further throttled up on construction costs, well above the general rate of inflation. While we do see year-over-year declines in September, much of this is adjusting for these larger spikes that occurred in the previous 2 years. We'll have to pay close attention to the cost of construction materials moving forward, as potential tariffs remain a threat to overall building costs. Jumping right into our residential outlook, this picture is of One Chicago Square apartment towers that broke ground in May 2019 with a total value of $653 million and 975,000 square feet. This is one of our largest residential projects to break ground thus far this year. This slide goes through the basic pattern that we see moving forward for single-family housing starts. After the Great Recession, single-family housing starts peaked in 2018 and will have a mild decline heading through 2020, as the residential markets will not escape the overall economic slowdown that is coming. Single-family housing starts rose over the year in 2018 as seasonally adjusted starts peaked in the first quarter. By the beginning of 2019, starts had already begun to pull back, and they're expected to be lower than their year earlier level. A clear sign that with the conclusion of the year, we expect to tick down. For a full year of 2019, single-family housing starts are expected to drop 3% to 805,000 units, with economic activity expected to further weaken in the following year. The downturn in single-family housing will extend into 2020, as I mentioned, hitting a bottom of 765,000 units, 8% below the peak. This will be a very mild downturn for single-family housing starts, primarily because it falls in the expansion that barely got off the ground. Even at the 2018 peak, single-family housing starts remain 49% lower than the previous peak in 2005. Despite low interest rates, the overall uncertainty around the current economic environment have been a detractor to new home ownership. As more millennials come into the home buying age, there is a large demand for entry homes, and while affordability has certainly improved, there is difficulty meeting the demand for these entry-level homes. The changes to federal tax laws in December of 2017 have also contributed to the slowing of the housing market. Specifically, this stems from a $10,000 cap on the deductibility of state and local taxes and the lower limit for the amount of mortgage debt on which interest payments are deductible. This graph here basically just shows you that there's been a strong correlation between housing starts, home sales, and mortgage rates. This graph has the green line, which is the mortgage rates, and then total home sales would be the blue line. And generally speaking, new home sales are an indicator of demand for new homes, and home builders try to keep supply, which is construction starts, in line with demand. Mortgage rates have a direct effect on the cost of housing and are typically a key factor in determining the level of demand. Throughout 2018, as the Fed pushes rates up, home sales went down, and as the Fed lowered rates, home sales went up, as you could expect. By September 2019, mortgage rates began to edge up once again, raising the possibility of a renewed slowdown in home sales. The larger issues facing the U.S. economy could have a negative impact on home sales as well, and housing starts in the coming months. The economic expansion turned 10 years old in this past summer, and by business cycle standards, that's incredibly old. A 10-year business cycle rarely happens, and it looks to be entering its final stages. Also, uncertainty caused by recent trade battles with China and the higher cost of goods resulting from new tariffs are increasing the cost of construction materials. And that may eventually end up being the cause of a downturn for the overall economy. Over history, looking specifically at the graph, you can expect to see various points Whereas mortgage rates move lower, the green line, total home sales have responded in kind, moving up as homes became more affordable. This is most obviously demonstrated in that 2010 to 2014 gap, whereas the mortgage rates fell steadily, total home sales responded, positively climbing upward. Lately, however, due to just general economic uncertainty, we can see near the end of the chart that total home sales haven't responded at nearly the same level as we've seen in the past as in regards to mortgage rates movement. A lot of this is just attributed to general fear and uncertainty. Moving to multifamily home starts, multifamily housing has been a powerhouse of strength throughout the construction recovery and reached 542,000 units in 2018, up nearly 300% from the 2009 bottom of the cycle. But last year was the pinnacle of the current cycle, and starts are expected to decline both this year and next. This year, slower economic growth will prove to be a drag on multifamily housing, and starts are expected to fall 11% to 485,000 units. Dollar value is also expected to drop. Starts will continue to decline in the following year, where they slip another 15% to 410,000 units. Declines, however, will be limited by favorable demographic trends and recent tax changes that will keep multifamily housing a favorite of the investor community. Despite its longer-term potential, the near-term prospects for multifamily housing are looking less optimal. A key driver for multifamily housing is employment growth, as the income generated by these jobs enables new households to form, thereby creating an increase in demand for housing. Due to the very low unemployment rate, little slack remains in the labor market to meet growing demand, a condition that is expected to be exacerbated as the expansion continues to age. Thus, multifamily housing starts have likely reached its peak, and overall demand is expected to decelerate alongside larger economic trends. This graph just briefly details our top dollar value metros through September 2019, with their year-to-date increase or decrease after them. So New York has the most value at $12.9 billion, but it did see a year-to-date decline. So the first 9 months of 2019 summed versus the previous 9 months versus the first 9 months of 2018 summed, you've seen a 2% drop. But you can see some of the normal culprits at the top: New York, Washington, D.C., and Los Angeles. This is just sort of taking a closer look at the previous slide. As you can see that this is just a list of our top multifamily projects through September 2019. And at the top of the list, you can see that One Chicago Square apartment towers building, which was on the introduction slide to the residential section. And as you go down the list, you can see New York, California are again dominating this list, with Chicago trickling in a few places. Moving to our commercial outlook, this is a rendering of the Times Square Broadway Hotel that broke ground in March of 2019. The project will begin with the demolition of the Palace Theater and will be replaced by a 46-story tower with retail and entertainment space. The theater will be elevated 30 feet and secured within the new building and will be completely renovated, after which a 669-room luxury hotel will be built around it. Retail has taken a beating in New York City in recent years, and both landlords and retailers are being forced to find new creative ways to engage customers. If you look at this rendering, you can see the giant screen, and the builders are trying to go for a completely immersive experience that you can't duplicate with online shopping. The bottom of the structure will all have big glass pane windows, and it's trying to be a full immersive experience, something you can't duplicate from your couch at home. Specifically for Dodge, commercial buildings include stores and shopping centers, warehouses, office buildings, hotels and motels, and lastly, garages. Commercial construction, like housing, typically turns early in the business cycle, and like housing, the peak for commercial construction is directly in front of us. The dollar value of commercial buildings is expected to peak this year at $127 billion, up 3%. In 2020, commercial starts will decline in both square footage and dollar value as the economy softens after a decade of expansion. This slide here is just the overall breakdown of where we see the different categories moving in 2019 and 2020. I'm going to speak specifically to some of the other categories as I move forward, but I won't go into more detail on retail. So just generally speaking, the sector has shifted away, generally speaking, as far as retail goes, since I won't touch on it later. With e-commerce sales slowly increasing their share of the market, the days of retail really dominating are behind us. And this has caused the sector to have a reprioritization from new construction over to alterations, and I'll show you that in the next slide. So this graph basically just demonstrates that renovations are becoming a more significant portion of total work for U.S. retail. Before the recession, you can see alterations to existing facilities averaged 18% of retail construction starts, while new constructions averaged 75%. The remaining 7% consisted of additions to existing structures. As construction declined from 2008 through the bottom of the construction cycle in 2010, the new construction share dropped to a low of 50%. At the same time, alterations jumped to a record high of 45% in 2010. During the early part of the recovery, the new construction share of starts increased and alterations decreased, as one would expect during an expansion. However, as retail construction again pulled back from 2016 to 2018, the alteration share jumped once again, reaching 45%. At the same time, new construction fell back, matching its recent low of 50%. This tells an important story about the changing retail landscape, as since 2016, retailers have generally not expanded their footprints, but are updating and improving existing facilities to remain competitive with these new e-commerce options. Moving specifically to warehouse building starts, U.S. warehouse construction is set to increase 7% to $25.3 billion by the end of the year, with a slight drop-off in 2020 expected. There has been substantial demand for warehouse space, primarily on the back of e-commerce. Vacancy rates have remained low on the back of this strong demand. As consumers expect more of their online purchases to arrive quickly, thanks to services like Amazon Prime, this has steered demand towards regional distribution centers, with the primary focus on getting items where they need to go quickly. The slight decline will primarily be due to the slowing global growth, trade spats, and general tariffs that will bring down the volume of both imports and exports. On this slide is again showing some of the largest year-to-date warehouse projects in our database. And as you can see, this is largely dominated by Amazon, which shouldn't come as too big a shock to anyone. There are a number of huge projects, with the scope of the projects ranging from 437,000 square feet to nearly 3.4 million. With the new demand, the way that warehouses are being built is evolving. So as e-commerce remains the primary driving force behind large portions of new demand, there's a need for innovation. As next-day delivery and same-day delivery, and eventually the possibility of mainstream drone delivery, large warehouse spaces need to be able to exist closer to these urban settings. This photograph demonstrates a possible direction of more warehouses in the future. Notice the multi-level warehouse with a loading ramp allowing for direct access to the second level. Builds will need to be more creative with the limited space as proximity becomes increasingly important. This building is actually unique to the United States in terms of its tri-level structure where a truck could drive to any level, but they do exist all over the world, so we're just a little bit behind on this trend. Looking at hotel building starts, hotel starts shot quickly out of the gate following the recession and saw remarkable growth during the recovery. The 2018 level for hotel construction is expected to peak as the current economic expansion starts to wane. Starts are expected to take a small step back this year and again in 2020 as business and leisure travel pulls back. Hotel starts are often closely tied to the development of casinos and convention centers, and this was a boon to the sector during the recovery. As most states now have some sort of legalization around gambling, future expansion due to that specific development of casinos is likely to slow. As far as convention centers are concerned, broad-based economic growth, strong gains in business travel, and healthy corporate profits, in large part to the 2017 tax cuts, boosted new development. With economic growth expected to slow over the next few years, convention center development will also slow. As we take a closer look at office building construction, the main driver for office building construction is office employment. So construction activity has always been closely tied to economic ups and downs. Following the Great Recession, economic growth and employment recovered at a slow but steady pace, and gains in office construction played out accordingly. Because office construction came late to the recovery in the commercial construction sector, it is expected to have one more year of growth in 2019 before construction begins to decline. The dollar value of office construction starts will advance 6% this year to $50.9 billion. In 2020, starts are expected to head downward as the economy softens, pulling employment growth down along with it. The dollar value of office starts are expected to pull back 2% to $50.1 billion in 2020. As the years have rolled on, data centers have become a larger share of office construction, and although Dodge Data and Analytics does not track data center construction as a standalone category, recent trends in data center starts have been identified by searching the individual projects in the database. The analysis shows that data centers have become an increasingly important part of the office market since the end of the Great Recession. In 2017, data center construction total accounted for about 13% of total office value, and as you can see in 2018, data centers took a sizable jump, almost doubling the previous year, as their share in value increased to 22%. In 2019, data centers are expected to remain a key piece of office construction. Top data center owners, unsurprisingly, include Facebook and Google, with Facebook being far away in the lead. Looking at the graph, we can see on the graph you have office employment, which is the green line, and then general office vacancy rate, which is the blue line. And we can see during the recession how high vacancy rates shot up and their steady decline during the economic recovery. The vacancy rates continue to fall despite added supply, which is a good sign of the general health of the market, as office employment is the main driver. The labor market will continue to tighten, however, as the economy prepares for a deceleration. This slide is largely just to demonstrate the sort of scope of these data centers, and here are some of the largest year-to-date data center projects thus far in 2019. An added challenge with these large data centers is the secretive nature of many of these projects. When most of these projects are in planning phases, they have code names such as Project Echo and Project Osmium. Luckily for us, they have rather similar specs, which makes picking up on them and accurately including them in our database much simpler. Lastly, we will turn to the manufacturing outlook. Pictured here is the Toyota Mazda manufacturing plant that broke ground in Huntsville, Alabama, worth a total $1.6 billion and 6 million square feet. It broke ground in March of 2019. Specifically speaking, manufacturing is a somewhat volatile category as high-value projects drive the trend. Even looking at this chart, you can see the volatility that comes with the sector. One petro plant can choose to move forward and boost a given year by $10 billion. So specifically, manufacturing starts are expected to take a step back in 2019, with dollar value slipping 29% to $23.1 billion. Risks to the manufacturing sector have tilted to the downside, as trade actions against China and the European Union have led to increased uncertainty for U.S.-based manufacturers, who have eased new orders, production, and employment. The uncertainty has been further exacerbated by slowdown in economic growth in other countries such as Canada and China, in the European Union, which is not only dealing with a pullback in industrial activity, but also uncertainty surrounding Brexit. These issues have led to an expectation of slower economic growth in the U.S. This graph shows the industrial production of manufacturing versus the weighted average exchange rate of the dollar. In general, manufacturing output has eased back in 2019. While manufacturing production did rise 2.3% in 2018, thus far this year it stumbled below those previous levels, as manufacturing capacity utilization has also declined, and that's basically just a fancy term for productivity of the sector. Recent readings from the Institute of Supply Management Manufacturing Survey have also indicated that the sector has been contracting for at least 2 months. ISM's Purchasing Managers Index for manufacturing was below the neutral 50 level in August, September, and October. This marks 7 straight months of softening or contraction in manufacturing. Within the survey, production, new orders, and employment indicators all declined, which portends future difficulty given the high levels of manufacturing inventories also revealed in the survey. On the bright side, even with the pullback in manufacturing, some sizable buildings broke ground through the first 9 months of the year, including the $1.6 billion Mazda plant that I showed you, a $1.5 billion petrochemical plant in Louisiana, and the Foxconn $1 billion plant that broke ground in Mount Pleasant, Wisconsin. There's also a $1.3 billion petrochemical plant in Texas. Until there is some surety regarding the trade situation, the manufacturing sector is unlikely to post anything but subpar numbers. And with that, that concludes my section of the presentation, and I'll pass it over to my colleague, Donna.
All right. Thank you very much, David. That was great. So I'm going to be presenting to you some data from our Commercial Construction Index. And the first thing I should do before I move on and describe exactly what the index is clarify how my talk and my section is a little bit different from David's. There's two major differences. First of all, his is a carefully constructed forecast built from the bottom up from Dodge data. We, on the other hand, do market research in the Commercial Construction Index to gauge how the construction industry themselves feel. Now, you'll see that there's a lot of echoes to a lot of the factors that David reported on. So the industry is very sensitive to the things that are influencing it. But this is not a forecast, nor is it anything built from the ground up. It is very much just measuring the what contractors are saying about their businesses. So that's the first important difference. The second important difference is the word commercial. Dodge has a very specific and precise definition of commercial, but we were working with the U.S. Chamber of Commerce, who publishes the Commercial Construction Index, and their definition of commercial as far as construction goes is much broader. It includes it includes institutional. It's pretty much everything that's not industrial and not civil construction. So it is a pretty broad swath that falls under this commercial construction. So what exactly is this index? Well, they publish quarterly a report that's based on a survey that we do with about 200 members of our Dodge Data and Analytics contractor panel. And we build together an index figure that's based on 3 different pieces. I'm going to go through them in a little bit more detail, but it's basically backlog, their confidence in the ability of the market to provide new work, and their anticipated revenue growth in the next year. But we know that while those things really do add up to a telling index number, we know that those don't present the whole picture. So we also include in the survey every single quarter examinations of key factors that impact their business, impacting around labor specifically, around their access to financing, and around cost of materials and equipment. And I'll touch on that data as well. And then finally, we do a spotlight question every quarter. We just want to use this opportunity, since we're talking to the industry, to find out where they stand on some interesting trends. And I have 3 different spotlight topics that I'll be finishing with today. But first, let's dive in. Oh, and one quick thing about this Q4 number. The timing of this webinar is perfect because the Q4 Commercial Construction Index was just released today. It is hot off the presses, so we have not presented anything at all on this data before, and I'm really pleased to be able to share it with you guys right on the day it was released. So the Q4 number we see, it looks pretty low, especially if you compare it to Q3. But I want to be cautious, and we'll look in this in a little bit more detail, that this really, if you compare it, say, to Q1 2019, it's not crazy out of whack with everything we've seen. It's just more of an adjustment back down. What we've seen, actually, is a lot more. The first 2 years we did it, we saw pretty steady numbers in the mid-70s. And then this year, we've seen numbers go down and we see numbers go up. We're seeing a little bit more of that volatility that suggests that there's more uncertainty in the market, some of the uncertainty that David was tapping as well. So, like I said, that 71 number is made up of 3 components. There's backlog, new business, and revenue. You can see that all 3 components are down from Q3. Backlog went down 6 points, new business went down 4 points, revenue went down 6 points. And again, that looks pretty grim if you're just doing a quarter-to-quarter comparison. So I wanted to show you the entire year of 2019 to, again, give you a sense of how these numbers actually fit in this quarter. So you can see we go from Q1 to Q4, left to right. Q4 are the purple numbers. And looking first at backlog, we saw in Q2 and Q3 of 2019, the backlog number, that ratio of what people say their current backlog is to their ideal backlog, so that we have a measure that isn't impacted by the size of the contractor, because we have everything from very, very large contractors to very, very small contractors participating in the study, and we wanted a measure that didn't, didn't say 3 months is good or bad, because of course for a very large firm, 3 months would be terrible. For a very small firm, 3 months might be great. So we wanted a measure that would be more consistent across the board, and that's the ratio of current to ideal. For the first time since we started doing the survey 3 years ago, the ratio went up to above 80 in those 2 quarters, Q2 and Q3 in 2019. So when we see it going back down to 76, that's actually just sort of a readjustment back after a really enthusiastic set of quarters about backlog. We're still at very high levels that reflect the very positive nature of the market. New business confidence score, again, same thing. We saw a big acceleration in Q3, and we see that this is a calmer number, but it's certainly in line with what we saw back in Q1. And with revenue, it's interesting. I actually almost wish we had a few more pieces of detail on this chart, because for a lot of 2018, we started seeing revenue numbers decline. And this is not that revenues are declining. This is that not as many people were reporting increases in their revenue. So just to be clear, this isn't that people are losing money out there. This is just that, that there's not as much increase in revenue as one might have expected for, say, such a really strong backlog number. Then in Q3, we were all surprised to see that number shoot way up, back to where it was almost a year before that measure occurred. This quarter, we just see it just right back down to where it was in Q2. So that Q3 number appears to be a little bit of an aberration. So overall, we do see very positive, and the contractors are very positive about the key factors of their business. For instance, access to financing. Most contractors report that they think building owners either have the same access to financing that they did before, or that financing will actually get easier in the next 6 months. So that's about 70% of them say that they really see owners being able to finance their projects. Always a huge issue in the industry. And their own access to being able to have working capital for their business has also remained strong. 81% see that either getting easier or remaining the same. Again, positive numbers we've seen pretty consistently since we started to track this with the positive market we've been in since we started this process. But back in 2018, we saw a really high level of concern, especially with the tariffs coming in and a few other things about material cost fluctuations. We saw that go from really nominal in 2017 to really shoot up noticeably in 2018. In 2019, what we see is a little wavering around it. You can see this reflected in the 3 bars on the screen. If we just look at the moderate and high impacts, though, we can see that generally concern is going down a little bit from its high in Q2 2019. That contractors appear to be getting slightly less concerned that material cost fluctuations are having a major impact on their projects. So what about product shortages? About half say they are experiencing them, but interestingly, most only say they see a moderate impact from those product shortages on their projects. And if we see any kind of shift at all from last quarter, it's from going from 14% seeing a high impact and the same amount seeing a low impact, to just 8% seeing a high impact and 24% reporting low to no impact. So this is going to be an interesting number to keep an eye on. It will be interesting to see if concerns about product shortage impacts on projects continue to decline, or if this is just, again, a momentary little blip in the data. So this is good. This is one we're going to keep an eye on for the next few quarters. Tariffs, though, do remain a concern. And just to be clear, the percentages you're seeing on the chart are those who expect a high degree of business impact from tariffs. So those who are expecting a moderate degree are not included in this chart. And between last quarter and this quarter, we see that the steel and aluminum tariff concerns actually crept up a little bit. I think we started seeing a decline in Q2 in terms of the percentages who were concerned about this, because it looked like there might be some resolution back in the second quarter when we were fielding the survey on the horizon. I think now contractors are pretty much settled in, knowing that they're not going to see an immediate resolution to the situation anytime soon. So we've really seen concern on tariffs level off at a pretty high level, that 40% are expecting a high degree of business impact. That's almost half the industry. That's really worth noticing. They're less concerned, though, these days about new material and equipment tariffs, or generally about trade conflicts with other countries. Hiring expectations, though, despite some decline in confidence, they are still employing. Over half say they're going to employ more people in the next 6 months. And then another 39% say they expect to keep the same number. And I do want to point out that you have people get injured, you have people retire, you have people who move on to other jobs. So if you're saying you're keeping the same number of employees, that could easily mean you're hiring some people that year. So there's very few, almost no one thinks that they're actually going to be employing fewer people. And with the robust job market, this is not surprising at all. And what we see is that the difficulty in finding skilled workers remains consistent. We have seen some shifting around, but it's always pretty much been between difficult and moderate. In fact, this is the first quarter where we've seen a little bit of growth that's notable over more than one quarter in the low scale. That we're in Q2, low is 6%, now it's 11%. Now 11% is still tiny, right? That only 11% of people are saying that they're not having difficulty finding skilled workers is telling in and of itself. And yet, it is interesting that the number's trending up. So we'll see, if that is a trend, and again, this could have as much to do with a little bit of softening in terms of how many people think they're going to be employing more people. Those two numbers could be related. But we are still seeing them reporting that these skilled labor shortages impact not just their business, but the construction industry in general. Now, the vast majority say they ask workers to do more work. The current numbers are the purple and the purple numbers, the gray numbers the previous quarter. But almost 3/4 are challenged to meet schedule requirements because of skilled labor shortages. And 2/3 are actually putting in higher bids for projects. So projects are costing more and they're being delayed. So this is a major industry impact, to the point where, again, we have 40%, over 40% saying, no, we are not even looking for new opportunities of work. We're actually turning away work because we're so concerned about labor. So there is no doubt that this is going to continue to impact the industry going forward. Now, one of the more interesting parts of this particular survey that we do every quarter is we actually give the contractors a chance to just say whatever is on their mind in 2 questions. We ask an open text question for what do you think is the greatest opportunity in the next 12 months for your business. And then we'll ask them the same question about challenges. But for this slide, let's focus just on what they had to say about opportunities. Now, since we started doing this, because we've been in such a boom market, by far the greatest new opportunities have been new projects, new construction. You can see those words leap off of here. But look at some of the other things they point out. First of all, institutional work appears to be growing. We see healthcare as a really dominant thing, and we also see public as a relatively big word. Private work is slightly smaller, and that follows some of the forecasts that our economists have put out in terms of what's going on with off the office market diving back a little bit. Economy is still it tends to be mentioned a lot in the positive discussion. And what's notable too, over in the lower left-hand corner, is profit. We did get several pointing out that they felt they were seeing higher profit margins in this particular business cycle than they've ever seen before. Now, a few others actually in the challenges felt that they were seeing challenges with profit margins, but generally a lot more are mentioning profit and profit margins than we saw a little while ago. So those are the key things that they're pulling out where they really are very positive about. Now, what are the biggest challenges that they report when they're just allowed to write everything? Again, skilled labor has always been a dominant one here, and it still is. If you add in labor and workers together there, that word would be so much bigger. You can see that that is the huge issue. Economy is also here. So while there's a lot that are enthusiastic about the economy, there's a lot of concern about the economy too. And I think, again, that goes back to a lot more of the uncertainty, the little bit less stability in the findings that we're seeing, where some still seem to be very positive and some are seeing some negative outlooks. So, you know, economy shows up here in a big way. Another thing that David mentioned, and that the contractors definitely are feeling as well, is that going into an election cycle, politics and the uncertainty that's associated with politics right now in particular is something that's brought up quite a bit, and we've seen that emerge in the last quarter or two as a much bigger factor than it was in the terms of these big challenges than they mentioned in the past. You know, I think that there's a lot of uncertainty right now in general, and on top of that, I think there's some real concerns because we know that the construction industry tends to be very enthusiastic about a Republican administration, and I think there's some concerns about what's going to happen in 2020. Backlog is actually showing up now as a challenge, not an opportunity, and you know, we do see the tariffs. Again, tariffs is another big word that jumps out. I think for those who really are concerned about tariffs, it's a big issue. All right, so that's it for our quarterly data. Now I want to shift to our spotlight topics, and there's 3 of them. The first one I'm going to talk about is resilience. In our Q3 study, we realized that you know, there's so much attention, especially around the third quarter, in terms of how buildings fare against the challenges they face with severe weather and with natural disasters. There's been a much bigger focus on resilience in the last 3, 4, 5 years than we saw previously, just in general in the industry. But very few people have gone to contractors and asked them what they think. They tend to be focused on other areas of the industry. So we wanted to take a little bit of a deeper dive and see what contractors think about this issue. So the first thing we wanted to understand is we wanted to ascertain the resilience of their own businesses before we got to the resilience of the actual buildings they construct. So we asked them, have you experienced schedule delays due to extreme weather events? To what effect are their businesses, being impacted by this? 75% of GCs and 56% of trade contractors have experienced those schedule delays. Now, to be clear, this isn't a disaster. This is they tend to report. We did ask a follow-up question on what percentage of your projects, and most of them reported it was on below 5%. So this isn't a common thing, but still, it is experienced by most of the contractors out there. So, given that, we wanted to know, well, to what degree do they even take this into account, the likelihood that this might happen? And we asked them 2 questions about that. First, we wanted to know whether they include the impact of weather when calculating their project bids. And 61% of the general contractors said yes, even though 75% had experienced actual weather delays. And you'll see the trades have a similar disconnect. And when it comes to actually considering project risk mitigation plans for natural disasters, we see that's even lower. Only 45% of GCs report that, and less than 20% of the trades even have any kind of risk mitigation plan for a natural disaster at all. So there is some work that contractors can do to make their businesses more resilient. All right, so that's their businesses, but we're also very interested in resilience of the buildings they're building. And one thing that's driving resilience, of course, in the U.S. is codes. And we were curious to see what the contractors, the people who really are intimately dealing with the codes, think of them. So we asked first if they agree, whether or not they agreed that resilient building codes are necessary to help buildings withstand natural disasters and severe weather. And about 2/3 said, yeah, we think that of general contractors, and even more trade contractors think that. So most of the industry tends to agree that resilient codes really are needed. And only 20% of general contractors and 12% of trade contractors think that these codes are really burdensome. So overall, positive input on the codes. We also wanted to know, do you think they're effective? Do you think they're really making buildings more resilient? So the good news is that the green colors on the bar are the percentages who consider them at least somewhat effective. And you can see it's the vast majority of contractors believe that these codes are somewhat effective. Very, very few, under 10%, say that they really don't think they're very effective at all. But I do want to point out that the vast majority of the percentage who think they are effective only think they're moderately effective. They don't think they're highly effective. So there's definitely interest in the industry. There's definitely a degree to which contractors believe this is an area that can be improved. All right, we also wanted to know who they thought was driving resilient buildings. And it's no surprise that there's general consensus that it's the owners of projects. They're the ones who have to pay for resilience. They're the ones who have to be willing to take the time to plan it in, even make it a priority in projects. It's also not surprising that a certain percentage of them really felt the architects had a big influence on it. Resilience is often something that people credit as really needing to be taken care of in design. However, I did personally admit that I was surprised that absolutely no contractors in the survey thought that contractors were the top people who made a difference at all. So they do not think that they're the ones moving the needle in this right now. Since we knew owners were going to be a strong performer, we also wanted to understand what the contractors thought about how engaged owners are with resiliency. And now you can see that there's overwhelming agreement that owners care about this issue. But what's interesting is that only 22% of GCs and 20% of trade contractors feel like that interest has increased in the last few years. So I don't think contractors think this is somehow a response to more weather events or anything else. I think they feel that owners have always been interested in having good, durable buildings, and that's what the first number reflects. It doesn't really reflect something where they think the owners are responding to the current situations. All right, the next and final spotlight topic is technology. A year ago, oh no, I'm sorry, the second one. We have one more after this. A year ago, we did a survey on advanced technologies. And we did the exact same survey on a few questions again this year and the Q4. And the findings were really interesting. You can see we asked about 8 different technologies, the 6 on the chart, and then we did ask about 3D printing and automated equipment and robotics as well. In this chart, the dark gray bar represents the responses we got last year. How many said they were actually using each one of these technologies? The light gray bars represent how many say they are using them right now. And then in the current survey, we asked them, well, how do you think you're going to be using these technologies by 2022? And the percentage of here reflects how many thought that within the next 3 years, they were going to be using these technologies. And you can see that even though we're just talking a short time frame, year over year, we see growth in the use of drones, equipment tagging, reality capture, RFID tagging. All of those have already grown. And when we look at what they think they're going to be using in just 3 years, equipment tagging and wearables in particular leap out as areas where the contractors are very interested and really think there's potential for these technologies, enough that they feel confident that their companies will be investing in them. The particularly interesting one is wearables, where it goes from just 6% who are using them now to full 33% who expect to use them in the future. I do want to point out, too, that usage and anticipated usage for several of these technologies was much higher among general contractors than among the trade contractors. And when we look at, again, we had that list, remember, of all the technologies. Well, they did have the option of saying we don't use any of them at all, of course. Back in 2018, almost half said, no, we don't really use them at all. 40% this time said that. So we have 60% at this point who say they're using a technology like this, and 80% think they're going to be using one of these technologies in the future. Now, I do want to be very clear and pause for a second here and say this is not a forecast. We are not saying that 80% of the industry is going to be using one of these technologies, but it does indicate interest and enthusiasm and an expectation for investment in them on the part of the contractors. So it's worth paying attention to. Again, GCs were a lot more enthusiastic. So when we look at those who say already 3/4 of the GCs are using at least one of those technologies, I think that's actually a pretty impressive number. Most of them are using drones, but still, it's a very impressive number. And over 80%, 88% exactly, are going to expecting to be using one of these by 2022. Finally, we did want to take a quick look at women in construction because, of course, workforce issues are a huge issue, and one of the key ways, there's a lot of different ways we can address this, including technology, but one of the key ways is to try to bring more women into the workforce. And certainly the survey supported this. We asked them what percentage of their on-site workers were women, and the average came out to 7%. So, really, there's a huge underrepresentation of women on the job site. No surprise, I'm sure, to anyone on the call, but even among you, 7% is a pretty low number. So what's keeping the women away? What are the top obstacles? Well, 56% did feel that the physical nature of the work on site was a bit of an issue, but an equal number felt that there was a perception that construction was a hostile work environment for women. That's a huge factor that could be addressed in a lot of ways. There's also interest in mentorship. It's not about pay gaps. It's not about inflexible hours. It's not about those hardcore employment things. It seems to be much more about culture. And certainly when you look at the top ways to recruit more women, it supports that idea that it's about improving the culture. That almost half think that one of the top ways to recruit more women is to improve the perception of the construction industry in general, but also to provide more examples of successful women in industry, and to provide mentorship programs, and to create a more welcoming culture to women. These things, again, perform much stronger than just having a straightforward, clear path to advancement or better pay, things that tend to be far more influential when we're talking about the general population. So it does suggest that there's a lot of ways that the construction industry could very seriously tackle this issue if there was a great deal of interest. So with that, I want to hand it back to our moderators.
Thank you all very much for attending today. We hope you found the information useful and relevant. Take care. Enjoy the rest of your week.